I just put our latest multifamily deal into ChatGPT and told it to grill me like it was a sophisticated real estate investor analyzing this opportunity and told it to ask me tough questions. I want to show you what it's asking and how I'm answering it to see if River Club Apartments, located down in Evansville, Indiana, presented by Great Capital, is the right investment option for you. All right, let's take a look. I've had thousands of conversations with real estate investors talking about investing into multifamily apartment buildings, typically value add or kind of core plus opportunities around the Midwest, but I've never gone toe to toe with an AI asking me hard questions. So what I've done is I have uploaded our entire investment deck, the whole PDF, into ChatGPT and told it to thoroughly analyze the investment opportunity and then ask me hard questions about the deal as well as Great Capital. Let's see exactly what it asks. So you can see here on my prompt, I'm telling it it's a sophisticated investor. Analyze the attached deal. After it's read it, wanted to ask me a series of questions about the deal as it would if they were considering making an investment. Questions should be targeted at the deal as well as the firm, Great Capital. You should be detailed, nuanced, and smart. All right. It's done the analysis and ready for the first question. All right, ChatGPT, given the comprehensive nature of the investment deck for River Club, well, that's good to know, it's comprehensive. My first question focuses on the projected financials. Can I elaborate on the key assumptions behind the projected rental income growth and expense management detailed in the investment deck? Specifically, how does Great Capital account for making potential market fluctuations or economic downturns in its revenue projections for River Club? This question is aimed at understanding the robustness of the financial projections in the firm's ability to manage risk associated with market volatility. Okay, really good question, and it really gets at the kind of the cusp of the whole deal itself, because if the top line revenue projections, they've got to come from somewhere. So we're going to break down first starting with revenue, and then we're going to get into expenses. There are three primary drivers of revenue growth at River Club. The first being our renovation plan. We're targeting both an interior and an exterior renovation plan, really focused on the curb appeal of the project. So the first piece of the rehab project is we're going to be renovating about 50% of the units, right around 220 of the classic units, upgrading, spending about $13,500 per unit, replacing the cabinets, countertops, painting, light fixtures, hardware at the units themselves. We're going to be doing this in a rapid occupied fashion. So we have a specialized general contractor that will come in and renovate these units as they are occupied while the resident is away at work, allowing us to renovate these 200 units within a 12-month time period, accelerating the rate where we can increase rents and increase net operating income at the property. So that's the largest component. We're going in, spending around $13,500 and targeting a $200 rent premium at the property, or an increase on the current rents. Now, the current rents at the property are about $100 below the other comparable properties in the market, and that's including properties that are older and that are unrenovated, showing that we could just push rents organically about $100 today, but we think that conservatively, by upgrading the units, making them look incredible, we should be able to get an additional $100 on that top of that kind of $100 organic rent growth push. We think this is conservative, kind of getting into the risk mitigating factors. Typically, we think we can get probably $200 to $250 to $300 for this premium, but being conservative, only targeting $200, which also, you could target $300, including $200 premium plus $100 being under market. But for a total increase from the renovation of $200, we think is conservative and right in line with reality and what we can achieve. Second revenue driver is all of the it's also part of the renovation plan, but instead of just renovating and upgrading the units, we're going to be upgrading the exterior of the property and really increasing the curb appeal. So we're going to be painting the entire property, really transforming it from the way it looks today, which, is clean, but it looks like it was built, 35, 40 years ago, which the property was. It was built in the mid 1980s, and the color scheme, everything about it looks like it was built in the 80s, with a whole new paint scheme that is going to completely make the entire property stand out, pop, and look relatively new. No one's going to think it was built last year, but they're going to say, wow, this property is in great condition. Because the upsides for this property is it already is in good shape. The bones are really good, it's been well maintained, but it needs a really nice cosmetic upgrade. The third piece is just the organic rent growth in the market. Evansville is incredibly undersupplied in terms of housing. Evansville has been conducting a housing survey. They're calling for about 2,700 additional rental units over the next several years. There's only going to be maybe 1,000, if that. Most likely several hundred new units come online over the next couple of years. We know multifamily supply is going to really drop off at the end of 2025, which is right in the kind of the first inning or first two innings of the investment period for River Club. Evansville has been experiencing strong rent growth, kind of in the 4 to 5% rent growth range. And that's what we are modeling in our projections, seeing around 5% organic rent growth, kind of in the first year and a half. And then that's dialing down closer to 3 and then 2% over time. Again, the cosmetic upgrades at the property, given the fact that the units themselves are already $100 below market, as we upgrade, again, the curb appeal, make it look really nice, very confident we can achieve kind of that modest kind of 4% rent growth, 5% rent growth, because we've got a great property, a ton of amenities, and the units look great. And the property is going to look even better. In terms of expenses and how we control expenses, a lot of this comes down to technology and how we control spending at the property itself, from how we're controlling our maintenance teams, purchasing items, really staying on top of the budget, but also all the renovation work that we're going to be doing at the property itself is going to reduce the overall future operating expenses at the property. There won't be nearly as much exterior work that we're going to have to do, because we're going to be curing really any deferred maintenance when we touch all the exteriors of the property itself. Kind of furthermore, we're targeting deploying additional funds to replace AC condenser units and water heaters, as those can be a primary source of ongoing maintenance. By replacing those, bringing the CapEx funds at the beginning of the investment, we can really mitigate future expense liabilities from ongoing operating maintenance, just by replacing and making these capital investments upfront at the property itself. But also, we're overestimating our expenses at the property, even doing the things that I just mentioned. We're assuming that it's going to be a little bit more expensive for us to run it than the current owner. We think that we can beat their expenses, but we want to be conservative in this rising inflationary environment, just because we've seen costs rise, and we'd rather overestimate our expenses with an opportunity to beat it, rather than cutting things down to a level where we can't support the investment going forward. All right, let's ask the next question. Okay, tenant retention and leasing strategy. Given the importance of occupancy rates to the investment success, what specific strategies does Gray Capital employ to ensure high tenant retention and effective leasing management at River Club? Additionally, how does the firm plan to attract new tenants in a competitive market environment? And are there any targeted amenities or services being introduced or enhanced to support this goal? This question seeks to understand the operational strategy related to tenant management and leasing, crucial for sustaining income levels and maximizing the property's value. Okay, really good questions, and really exciting plan. I'm glad it asked this question, because it touches on a handful of different, I think, exciting aspects of the business plan. Okay, so the first part is the importance of occupancy rates to the investment success. What are our strategies to ensure high tenant retention? Really, the two questions, because the next one is the second part is about adding amenities or services being introduced. I think we need to start with the property itself and its history in the market, and why it's always been primed to really attract individuals that are looking for a highly amenitized living environment, rental option. So when Regency Club, which is the original name of the property, when it was built back in Evansville back in 1981 and 1984, it was absolutely the premier kind of lifestyle apartment community for younger-ish professionals living in Evansville, and has always kind of maintained that reputation. But obviously, some time has passed since the the mid and early 80s. Basically, 40 years has passed and times have changed. Some of the original amenities at the property, including, and I'll let you know which ones are still there, are a lot of handball courts. There are actually 4, originally 4, now there are only 3 that are still remaining. These are still used somewhat, but not as much as you'd think. There were originally 2 indoor pools. There's 2 clubhouses that are essentially mirrored of each other, and they both had 2 indoor pools. One of those indoor pools has been removed and replaced with a fitness center, and then they used part of the area for expanded maintenance, storage, garage. There is an exterior pool, which is new. Actually, it was built about 2 years ago. They filled in an old pool and built in a really incredible kind of large outdoor patio area, which we are planning to activate this spring. The current seller did this last year. A really huge outdoor concrete patio area. We're gonna have cornhole, ping pong, giant Jenga, fire pits, string lights, a really cool outdoor area for residents to kind of hang out in. I mentioned there's a brand new pool at the property. People love pools. This is brand new furniture, brand new fencing, brand new little pergola, brand new everything. There are 2 stocked fishing ponds at the property itself. Some properties don't let you fish. I'd say that it's almost encouraged at River Club, which is exciting. I'm a big fisherman also, and so we love being able to activate fishing opportunities at our properties themselves. There's a handful of community rooms at the clubhouse that we're going to be keeping at the property. Residents can rent these out for whether it's watching the Super Bowl, wedding showers, birthday parties, etc. It's a really nice feature. And then something we're looking at adding is we're going to demolish the second clubhouse, which isn't being used. We're going to be looking at adding additional amenities in that area, such as a pickleball court and pergola, to further, again, bring the Regency Club back as we're rebranding to River Club, into kind of maintaining the title of the lifestyle community in the Evansville market for young professionals. We're going to have more amenities than any other property in the market. And how that comes back into retention and maintaining occupancy is that you can't just have these amenities, but you have to activate them and engage the community with community events. The property manager, who we're most likely, almost certainly going to be keeping on staff, has been in the property almost 20 years. She already has a good history and track record of hosting quite a few community events. That's something that we like to do a ton of at Gray Residential, which is our property management firm at Gray Capital. So continuing to ramp up community engagement, community events. We've talked about a fishing tournament, obviously, for all the major holidays, getting people together. But we use a lot of technology to stay in touch with our residents, to keep them up to date, as well as having kind of a back office staff at our corporate office to kind of handle a lot of also kind of resident issues that may come up that we may not want our property managers only being the ones that deal with, especially if like a resident kind of falls behind on rent. Instead of having to deal with their on-site property manager who have to deal with in person, we have kind of a dedicated team here at Gray Residential where we can kind of work with those folks one-on-one and trying to find a good solution to get them back on track itself. So also the last thing I'd say in terms of occupancy and getting back to the first question of, kind of protecting for economic downturn, we're assuming occupancy kind of in the 94-95% range. The property has historically been kind of 96 to 98% occupied, really over the last 15 years. It touched 94 several times when they were doing a push to raise rents over the last decade, but it immediately within a quarter's worth of time, occupancy has increased back to 98%. So we anticipate that we'll see relatively higher levels of occupancy, but we have baked in a little bit of conservativeness in by using a lower occupancy rate than historical. All right, let's ask the next question of ChatGPT. Okay, it's asking good questions, and it's asking in a kind of two-part questions, but really kind of getting at the core fundamentals of the business plan. And there, I guess what I think this is good and why this may be useful for you, it's not always the answers to maybe the questions, but it's how we're answering the questions and can give you an insight into how we, I guess, think about the project as well. So, okay. ChatGPT, capital expenditures and value-add initiatives. Can you provide more detail on the capital expenditure plan and the value-add initiatives outlined in the investment deck, River Club? Specifically, how does your capital prioritize the investments, and what is the expected impact on the property's market positioning and rental income? The question aims to delve into the strategic approach to property improvements and positioning, assessing the balance between upfront costs and long-term value creation for investors. So I've already touched on a chunk of this, so I'm only going to cover some of the aspects that I haven't touched. I kind of talked about the general rehab plan for renovating half the units, the exterior upgrades, kind of the cosmetic upgrades, some of the new amenities, some of the preventative maintenance capex injections from additional AC condensers, hot water heaters. So how we prioritize these investments and what is the expected impact on the property's market position and income. So I think I think the last part is important. What's the expected impact on the property's market positioning and rental income? Because there are some projects that directly affect income of the property, and some it's very easy to quantify. So like renovating the units, $13,500 per unit, you get a $200 rent increase, $200 per month over 220 units, times 12. We can very easily quantify that increase to the overall revenue of the property itself. What's harder to quantify is something like replacing AC condensers. So no one's going to give you no one's going to pay more per month for a working air conditioning, but they may move out if the air conditioning's not working. So you see that show up, not necessarily in increased revenue, but you may see it show up in decreased retention over time. So that's a little bit hard to project and quantify, partially because you don't know how many issues you're going to have, when those issues will take place, how upset the resident will be. It's a little bit hard to quantify. Something else that's a little bit difficult to quantify would be some of the exterior improvements. Painting the property, it's going to look a lot nicer. I know we will get more leases, not less. We're not going to get less leases when the property looks better. But it's hard to say empirically before we've done it how many more leases, and then how much more organically on rents can we push because the whole property looks nice. Not only on the fully upgraded units that we're going to do, but also on the classic units that we're not going to do. I'd assume that if the whole building looks a little bit nicer, again, our close rate should increase a little bit. Can we push rents a little bit more? We certainly might be able to, but it's not as easy to quantify because residents focus and prioritize their unit first. Their bedroom, their bathroom, their kitchen, their living room, that's priority. Then maybe the hallway. And then, obviously the overall property, the look, the feel, the amenities, it all kind of gets wrapped in. But when we're looking at our own priorities, it follows a similar path. We're looking at what can increase revenue. So that would be the unit renovations itself. And then we're looking at, what is going to help us reduce expenses and that may provide an increase in revenue. So the exterior improvements would be kind of that next list of priorities, because by painting the exterior, by, that includes caulking and doing some deferred maintenance on the exterior. That's going to reduce overall issues on that exterior for most likely the life or the majority of the life for the investment. Investing into AC condensers and water heaters, that doesn't show up right away, but it's something you're going to have to deal with eventually. And so by getting ahead of that reduces ongoing operating expenses and big expenses to pop up. If a water heater leaks and you don't have a drip pan underneath it and floods a unit, that can get really costly very quickly, rather than being a little ahead of the curve and preventing that. So it's a balance between revenue and reducing ongoing operating expenses. But typically we're going to prioritize. I guess the first thing that we always prioritize is health and safety issues. Whether that's curbs that are dangerous, a balcony or porch that maybe the support isn't as strong as it should be. Those are obviously the first things that we have to do, that are critical to do, that need to be done immediately. But then it's what's going to drive the most revenue, what's going to be able to reduce our operating expenses over the life of the investment. And I think that some of those, you have to really analyze, what is your hold period for the investment. If you're going to be holding the property for more than a couple of years, you really want to look at some of those cost-saving measures versus if you're just going to be, flipping the property. You may not care about some of the long-term cost-cutting measures, which is good to know one way or the other. As you're going into the project for River Club, we're looking kind of at a 4 to 7 year hold period. So, we're going to hold on to it for a while. We want to set it up for the long run. We want to make sure we're not dealing with issues in year 5 or year 6 if we end up holding the project that long. All right, let's get into the next question. Okay, market analysis and competitive landscape. Considering the dynamic nature of real estate markets, how does Great Capital assess the current and projected competitive landscape for River Club, especially in relation to similar properties in the area? What factors are considered crucial in maintaining competitive edge in terms of pricing, amenities, and tenant services? The question seeks insight into Great Capital's market analysis capabilities and strategic position of River Club to ensure its success and resilience in the face of market changes and competition. It's a great question, and let me see if I can relatively quickly pull up our deck and share that with you, and see if that makes sense. If not, I can read off of it, and because this is a key part to any investment strategy, especially with real estate. But okay, what do the comps look like? What are the market dynamics? Real estate is incredibly local, and it's always local. So for River Club, I'd say the first, and you've heard me mention this already, is that we are about $100 below the market compared to most competitive properties. Now that doesn't mean that there aren't properties that are cheaper than River Club. There are, but in terms of the landscape, River Club, Evansville. Let's just start talking about Evansville. The Evansville market has a much older housing stock than your average city. So the average piece of real estate in Evansville was built in the 70s. The River Club, it's not a brand new. Built 1981 and 1984, and so it's actually relatively newer than a lot of the housing stock. Also, a lot of the housing stock in Evansville hasn't really been renovated over the last several years. It's mostly classic, which is fine, which is good for us. And it's also a little bit more expensive, surprisingly. So let's get through here and look at some of these comps. The other piece of the Evansville market is that the supply is incredibly low. And I'm going to touch on that in just a second, but now we're looking at the comps. Average rents, you can see this lighter gray bar graph. That is the River Club average. It says Regency Club now, it says what the name is before we rebranded it. This is Regency Club River Club in the market. Average rents around $990. You can see there are a couple of properties that are cheaper. Now, these are all properties that were built in the 1970s or 1960s. So older properties, some of them have been partially renovated. Abbey Court's been partially renovated. The Timbers, I don't believe, has. Village Green, just partially. These are all older properties. Now, properties that are charging more than River Club are also typically older properties. Like Ashley Point, for example, they're charging closer to $1,100 a month. This property was built in the early 70s. Pavilion Lakes is the same story. And then you have properties that are charging, all the way to the top of the market, closer to $1,400, if not in the mid-$1,000 range. Looking at one-bedroom comps, it just shows a similar dynamic of River Club being in kind of that back half rental rates. And just organically, River Club should be kind of just below the newer properties. Starting with the Reserve over here, so we should be a little bit below the Reserve, which is right around $1,000 for one beds, and just under $1,200 for two beds. But let's look at supply again. Market dynamics projecting future rent growth. The supply in Evansville, which is this bottom left-hand chart, has been falling off and has never really been that strong. In fact, there were a lot of demolitions back in 2023 that took quite a few units offline. You can see rent growth just to your right in Evansville. The property has been, really relatively sustaining. We didn't see the crazy growth during the pandemic. We saw strong growth, close to 10%. But still rents are really relatively affordable. But even as national rents have been declining, Evansville rents have actually been picking up. This top chart is occupancy. The bottom line being the Evansville market, you see it's really stable occupancy, kind of hovering between 94 and 96% occupied. But River Club, which is the top line, it kind of hovers really closer to the 95 and 99% occupancy range. There's just 2 points in time where it kind of hit a 94% occupancy level. So where the property is positioned in the market, as well as where the market is positioned itself, and the trajectory of the market is truly favorable, and we're really excited. We're really excited. Okay, so let's jump back into ChatGPT and see what the next question is. Exit strategy and investment horizon. Can you elaborate on the planned exit strategy for River Club and the investment horizon? How does Gray Capital evaluate potential exit scenarios, including sales, refinances, or holding for cash flow in alignment with market conditions and investment objectives? Additionally, how does the firm assess the timing and conditions that would trigger an exit to maximize returns to investors? This question is intended to probe into the strategic planning for realizing the investment's value, including the consideration for timing, market conditions, and the method for exit to best serve the interests of investors. Okay, excellent question. So that's why I love I love this question, because in multifamily there's so many good options, and having a very clear understanding of multiple exit strategies is important to any investment. And there are so many exciting options in multifamily. So I'll start with what is outlined in the investment deck as kind of our base case, and then I'm going to give into kind of some of the alternative exit strategies, and just kind of different ways that we look at it and how we do assess a potential capital event, whether that's a sale or a refinance, and just kind of the timing of that. And I'll do it in a narrative that kind of tells the story of the investment. So, as we close on the property, we're going to be doing a lot of work, spending a lot of money in terms of renovations, and deploying CapEx funds in order to force appreciation of the asset as quickly as possible. When I say force appreciation, that essentially means that we're going to increase the net operating income at the property, primarily by raising rents through our renovation. Since commercial real estate is valued based on essentially a multiple of net operating income, we can see a direct relation to the value of the property and the dollars that we put in, if those dollars lead to additional revenue generation. Another reason why that's why we prioritize kind of revenue generating kind of CapEx projects. So the first option to look at a capital event will be after the execution of that business plan, as we are seeing an increase in net operating income. That'll most likely take place closer to the end of the first year of operations, but typically on a normal project, it's in the second year of operations, because every property needs to go through somewhat of a seasoning process, which means you're not only adding value and forcing appreciation through your renovation strategy, you're also getting your hands fully around the best way to operate that property. You can have a really great kind of cookie cutter model of how you're going to go in and manage the property, but every single asset is unique. There's its own quirks, whether that's staffing, marketing, market dynamics, supply in the market. You have to be flexible. Things change, and so sometimes it can take. I can see it take 3 years to fully season an asset. And so while the rehab is kind of the quickest thing that happens, there can still be some time to fully realize all the rent increases, get management fully kind of right where it needs to be. And that typically takes, call it 18 months to 3 years. We want to season it as soon as possible, because as soon as we do, we're going to start exploring our first opportunity for a capital event in the form of a refinance. So a refinance would be a cash out refinance. We'd be looking at putting either new debt on the property or taking out a supplemental loan from our lender, Fannie Mae. This would allow us to take that cash, return it to investors, which will pay down their initial investment, but you still get to stay in the project itself. So your ownership remains in the deal. Your preferred return may change, because the preferred return is calculated based upon how much is left in your capital account, how much money you still have in the project itself. But cash flow should really increase from a cash on cash return level, because again, you're essentially taking chips off the table. I've done this multiple times where we've been able to take 100% or even up to like 130% of the cash out of the deal, getting all of your money back plus a 30% return, and then you stay in the deal and you keep cash flowing. We haven't factored this scenario into our model at all. I mean, we've certainly looked at it, but it's so hard to speculate on what interest rates are going to be in 2, 3 years, also where cap rates and valuations are going to be. And so while it's a interesting exercise, there's only so much value into it. But knowing that is part of our strategy, it's going to be something that we're going to be examining. Essentially, as soon as we get out of the bulk of the renovations, we'll start looking at, where are interest rates in the market? We'll start getting brokers' opinions of value, just to kind of see where the value of the asset might be, as well as communicating with lenders to underwrite the project for a potential refinance. And we'll do this essentially on a quarterly basis once we get out of that seasoning period, or once we're close to the end of seasoning. And then after that refinance, that may reset our prepayment penalty and make a immediate sale after that not nearly as attractive. So that goes into the thought process, as well as what kind of debt we're putting in place. Does that affect the overall time horizon for the project itself? We're still looking to exit around 4 to 7 years. So if we do the refinance in year 4, we want to be careful that we don't put debt on it that locks us out from a sale within the investment horizon. But if we refinance in year 2, pull out a lot of cash, we still could be looking at a sale in potentially year 5 or year 6. Again, what we would do is, and what we do across our portfolio, is on a quarterly basis, have ongoing conversations with lenders and brokers to give us their opinion on either a refinance or a sale, and what that would look like. And we look at the investment and the property and assess, how close are we to achieve our return objectives from an equity multiple standpoint and an IRR standpoint. Mostly focused on equity multiple. We're targeting at least a 2x equity multiple over 5 years. And so anything less than the 2x, we would really have to understand why it makes sense to sell at that point, rather than potentially refinance the asset, pull cash out, and continuing to cash flow. It also comes down to what that cash flow looks like after that refinance or before the refinance, and what we believe is the long-term prospects for the property. There's properties that continue to perform well and they're throwing off enough cash flow. You really have to question yourself, is there a better alternative in the market anywhere, and is this something I just want to hold on to for a long period of time and just continue to cash flow it? In that scenario, you'd want to refinance it as soon as you could to kind of get your cash out and still redeploy into another asset. You continue to cash flow it. If the property isn't producing cash flow that is really exciting, and it's not the investment that we thought it was, it may make sense if we can get that 2x equity multiple to sell it when we can achieve that and move on to the next asset. So it's a dynamic process that has to be revisited every quarter or so, keeping an ear to the ground on where the market is, but also having conversations with our investors and to see where their head's at. A lot of times investors will want to sell earlier than the business plan is called for. Everyone likes the idea of kind of a longer term hold, 5 to 10 years, but after 2 or 3 years, investors start saying, okay, I like the consistent distributions, but it'd be great to get a nice pop. Because there's nothing more exciting than a big refinance and getting most of your capital, or if not all of your capital back, or a sale and you're doubling your money, getting all of your money back. There's nothing as exciting as that. So you can see why investors would want that from time to time. Okay, we'll ask our final question. It's a final question. Make it a good one. Oh man, not a good one. How does Great Capital incorporate sustainability practices and considerations into its investment strategy for River Club, particularly in light of increasing investor and tenant demand for environmentally responsible real estate? Can you discuss any specific sustainable features or initiatives being implemented at River Club to enhance its environmental performance and appeal to a socially conscious market? The final question is proposing the firm's commitment to sustainability, increasingly important factor, yada, 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 yada. Okay, well, I am just going to say a couple things. Our priorities is to be at Great Capital is to be a very good steward of our investors' capital and stewards over the assets that we own and manage. And those are our priorities, but to be good stewards of those two groups, we certainly have to be conscious of any environmental impact to the property. It's important for our residents to have a clean, non-dirty environment. But this question is really aiming at kind of more global, macro, sustainable issues, and that I'm happy to talk about. Again, it's not necessarily in our prime directives or objectives to reduce climate change, but we love the environment. So here are some of the ways that we do try to make an impact. Obviously, the easiest way has been converting light fixtures over to LED fixtures, running the property more efficiently. Honestly, we can be more driven by reducing expenses that happens to have really powerful environmental benefit, and that's where we find the most success. Again, utilizing more water efficient, electricity efficient appliances and fixtures. I think that's like the no-brainer. We're also going to be installing EV chargers in locations across our portfolio and markets and demographics that drive EVs. There's a lot of work that needs to be done on that charging infrastructure. I drive an electric vehicle. A handful of folks at Great Capital drive electric vehicles. That's not necessarily just because they're good for the environment. I don't even know if the electric vehicles are good for the environment. They're just really cool vehicles, I guess, in my opinion. They go really fast, can tow a lot, do a lot of interesting stuff. But adding these electric hookups, I think, makes a lot of sense in residency. There's a lot of demand for residents who are buying EVs. Down in Evansville, Indiana, it's not the biggest market for this type of focus. So we have no pledge to be carbon neutral by any time. Although we'd love to be. Again, it's just not we're avid outdoorsmen in women here at Great Capital and Great Residential, but we are not necessarily our priority. We can only serve so many masters, and I mean, sustainability is not, to me, again, it's not an even question of environment. You having sustainable practices makes economic sense. So, all right, we're gonna do another question because that one, it's not good. I don't think it liked my response to the environmental question. All right, so, well, that was an interesting set of questions. You know, I would say that my critique of this process has been, and maybe it's because if I was inputting my responses and having it ask follow-ups, maybe it would be a better dialogue back and forth. It didn't ask any questions about, so here's my critique for this process. It didn't ask any really questions about Great Capital. I mean, it did in terms of like, how do we account for certain things in the business plan, or, you know, what's our strategy for leasing and things like that. Never really got any questions about Great Capital, about the firm or track record, and that's maybe more important than some of the questions about the deal itself. It didn't ask about any like the economic drivers of the market itself. There wasn't really a lot of market analysis. So much of the questions were focused on the deal itself, which they were mostly really good questions about the deal. The exit strategy is a great question. Market analysis, competitive landscape, it's a good question. That question could have gotten into more specifics related to the overall market and not just the deal itself. The capital expenditures and value add initiatives, great question. So the tenant retention leasing strategy was a really good question. I could have gone into more detail, I think, on that, on some of the technology that we use. And then the financial projections and assumptions. Really good question that gets at the crux of kind of the business plan. Like, how are you going to generate this revenue? What's the strategy here? I think it could have been more detailed. Again, I think that if I was providing responses and asking it to ask me follow-ups, I think it could have had some good questions. You know, my concern there was sometimes ChatGPT, I've noticed it can start tending to hallucinate as you start to deviate from the initial question itself. It kind of forgets the initial premise of the conversation. So it would then start referencing back just to that one question rather than the initial prompt itself. So I wanted to just kind of kept pushing out on the initial prompt itself. Maybe I'll hook my microphone up to it next time and I can have it transcribe my responses for the next time we do it. Well, hope you thought it was interesting. This was a little bit of an experiment I did in real time. We'll do some more of these. And I would say if you're an LP investor, I think it's a good case study for dropping a deck in from a sponsor and have it do some analysis for you. Again, you don't want to rely on it for all of your analysis, but if you're getting ready to have, let me put it this way. If I was an LP looking at a deal, if I just asked these sets of questions minus the sustainability question, that'd be a really good set of questions and better than the average questions that an LP asks a sponsor. I would say it's not comprehensive. They're not asking all the questions, but it would be a really good tool to supplement your due diligence on a deal or a sponsor itself. So, have you done this? Are you thinking about doing it? If you do it, let us know how it goes. All right, my name is Spencer Gray, president of Great Capital. We're a multifamily investment company based out of Indianapolis, Indiana. If you're an accredited investor, we do have an offering, River Club. It's the deal that I just went over. But you have to be accredited. Hop on over to greatcapitalllc.com to learn more. All right, do some more of these. Have a good one.